Let's go ahead and get started. So again, I am Marcia Nedland. I am a consultant, but I'm also one of the organizers of the National Middle Neighborhoods Initiative. And I coordinate the community practice. And the community practice, which has about 400 and plus members across the nation, is the sponsor of this webinar today, which is how partnering with the CDFI can get more loan capital into your middle neighborhood. So just a brief overview of what we mean by middle neighborhoods and the initiative. The initiative is focused on mobilizing attention really to what is going on with middle neighborhoods across the nation. And when we say middle neighborhoods, we basically mean not the most distressed neighborhoods, which usually do get a lot of attention, and certainly not the healthiest neighborhoods. As we have started to really analyze trends in middle neighborhoods, we find that they are disappearing either through the end result of a long period of slow decline because no one was really paying attention to them, or especially more recently through gentrification. And we'll talk a little bit more later about how the influx of investors buying single family homes is yet another new factor that's really affecting middle neighborhoods. So we do a variety of things, research, policy analysis, and so forth. But for the community practice, we try to connect people who are working in middle neighborhoods or who care about them through research or policy so that we can share best practices. So again, in middle neighborhoods, we're talking about most commonly, you would see that they were built as single family homes for families with children, which is a declining demographic, generally speaking, in the country. They tend to still be well more than 50% owner occupied. But often, if you look at the trends over time, that's eroding. The housing stock, and this point is really critical to the topic of today. I think the housing stock is aging, and although it's still in generally acceptable condition, often we find that it lacks features and updates that make it compete well for today's home buyers, except in the strangest of, hot markets like we experienced during the pandemic. And so one of the things that we're always trying to do in terms of, I guess, strategy in middle neighborhoods is to access the right kind of capital that would help get the housing stock updated so that it can be there for the next few generations of first-time home buyers, owner occupants, and high quality landlords. The other thing that's interesting is that we find that middle neighborhoods tend to be more racially, ethnically, and economically diverse than either their lower income or higher income counterparts. The reason that we're concerned is that as I mentioned, they're starting to falter in their sustainability, either through decline, which, has to do with who is the next generation to buy these homes when they come on the market, and sort of the related things about then who is the leadership for the neighborhood and who are the stewards of its future and its ability to deliver home equity to owners or revenue to municipal government, who governments often very much rely on this, the revenues from their middle neighborhoods. And then, as I mentioned in our next slide, some of them we're really seeing a lot of gentrification and displacement, not only of renters, but, as I bet many of you could tell stories about, competing with investors for the same properties and being at a disadvantage because investors have cash offers and contingencies, et cetera. So it's really become an absolutely dire situation in some neighborhoods, as I hear it from practitioners. And a lot of other practitioners are seeing the beginnings of that kind of dominance of their housing market by investors. So one more thing to call your attention to. At our website, middleneighborhoods.org, we have access to a mapping tool that would let you take a look at your MSA and apply one or another of the income tests at the left side of the screen there to sort of identify census tracts in your community that meet just the basic, different income guidelines. That may be a starting point for you to look at where your middle neighborhoods are and to think about digging a little deeper and looking at how they're faring over the last 20 years or even the last 5 years in terms of their ability to continue being a place where first-time home buyers can buy and people can have good schools and so forth. Okay, so today we have, as is often the case, a very expert panel to talk to us about CDFIs. And I guess I should give just the tiniest preface and say, one of the things that I observed in the community of practice membership throughout the country is that while some of our members are organizations that use lending as a strategy for revitalization, and others have not ever used that tool. And as lending regulations become more and more complex, it's not something that you step into lightly, I guess. So I wanted to make sure that practitioners of all capacities and all stripes in terms of their expertise and different kinds of strategies understood the range of lending products that could be available to them by partnering with a nonprofit that is a community development financial institution, and to get more customized capital into the neighborhood that meets the needs of your residents, either in residential spaces or in small business and personal lending. So that's kind of the point of today, is to give you an idea of what CDFIs are, give you an idea of a couple of CDFIs and the range of loan products they do that help middle neighborhoods across the country, and then give you some ideas about how you might find CDFIs in your community to partner with. So we have today Paula Plantaber, who's the director of lending at NeighborWorks America. NeighborWorks America has always been an organization that sort of started because of redlining by financial institutions a very long time ago. So lending has always been a key area of focus in terms of strategy for the organization, and Paula heads that up at NeighborWorks America and has been working for many years on helping NeighborWorks organizations become CDFIs and to access the capital that comes along with that. Gwen O'Shea is the CEO of a NeighborWorks organization, local one, in Long Island, which is CDC Long Island in Center Reach, New York. And Gwen works in a number of communities, many of which are middle neighborhood communities, on especially residential products, helping people either buy homes or rehab homes or do both. And then Lynn Myers coming to us. He's director of lending at Community Lending Work in Corvallis, Oregon. And his CDFI covers a number of counties in Oregon and specializes in small business loan products and personal loan products as well, which has allowed so many people to access really interesting, affordable, and well-designed credit products that meet their needs and help them, live better lives and have better communities. So I think what we're going to do is get started with Paula first, who I've asked to sort of set the table for us in terms of what CDFIs are and, what we should know about them if we're going to think about how we might partner with them. So thank you very much, Paula, and take it away.
Thanks, Marcia. Hi, everyone. Glad you chose to share some of your day with me. My name is Paula Plantaber. I've worked in the community development field since the 1980s, when the thought of a community development bank, a community development financial institution, was really just catching fire. Our industry's come a long way, but we still have many things to move the needle on. Next slide. I'd like to get to know you a little bit better. So if you wouldn't mind launching poll number 1 and helping us to know the audience a little better. Is your organization a CDFI, or do you have an affiliate who's a CDFI? Okay, I think we can stop the poll and share those results. So about a little under a third of the people in the audience today are either a CDFI or have an affiliate as a CDFI. And so the most important thing is that you will be our resources for the day, especially when we move into the question and answer part of our conversation. Okay, if you could launch poll number 2. Some of you are holders of capital and others seek the capital. So we just wanted to get an idea as to whether or not you have invested in a CDFI or you've partnered with a CDFI to invest in your neighborhood. Okay, I think we can end the poll. Okay. So we, as I had expected, and is most prevalent in the CDFI industry, we still have a long way to go. There's still a lot of room for the CDFIs in our country to make those kinds of impacts that we were all set up to be. Okay, one last thing, in getting to know you, if you could please launch poll number 3. Here are some financing needs that we have most often I see identified when we work with organizations across the country. If you can identify for us your top 3 that you as a CDFI or you as a community development organization or an investor or a government that's looking to invest in community development, where you've gone with your funds that have been available. And I know my colleagues who will be following me will be touching on some of these areas that they finance as a part of their CDFI work. Okay, so mortgages, affordable housing, micro small business, and then commercial mortgages, multifamily. Awesome. All right, well, thank you all so much for sharing in the polls and helping me and my colleagues get to know you a little bit better. So the focus of the webinar today is marrying, if you will, CDFIs or community development financial institutions and middle neighborhoods. I'll share tidbits of what constitutes being a certified CDFI, but there is more value in describing the work they do and how they make a difference in creating avenues and widening streams of capital flow into the hands of the underserved and the ignored. So as of the end of February, there were close to 1,400 certified CDFIs in the states and across territories, serving as regulated and unregulated entities. And the business model that they can take on are varied. A majority of them are loan funds. And in the NeighborWorks network, we have 82 certified CDFIs and approximately 25 that are seeking to become certified. Next slide, please. So the term certified CDFI is really a stamp or a designation, and it's issued by the Department of Treasury through the CDFI fund. If you'd like to know more about the CDFI fund and the programs that they have, it's the www.cdfifund.gov. Next slide, please. So changes are coming to those of you who are certified CDFIs or are proposing to become a certified CDFI. But for right now, there's 7 criteria that the CDFI fund has identified as requiring for you to meet when they basically put their stamp on you. That you have a mission of community development, that you be formed as a legal entity, that a majority, not 51%, but a majority of all of the lending lines of business that you operate, when they look at that the assets of your organization are mostly dedicated to lending, that you identify a target market, that you provide development services, that you are held accountable to the target markets that you serve, and that you're a non-government entity. The next slide. So not all organizations want to or need to become certified CDFIs. There's so many common characteristics of those that still provide community development finance, their mission, their purpose of why they exist, the products and services. In addition to lending, they may also be a provider of development services, of developing and development within the communities that they work. Service areas, still looking to tap into resources that can bring additional assets into the communities that they serve. And then partnerships, which are both formal and informal between the organizations and the people that are impacted by their work. Next slide, please. If you build it, will they come? If you have the capital to deploy, but no infrastructure to move those funds into the communities you serve, the money doesn't reach its intended purposes. CDFIs are created to stay the course. CDFIs are not a one program entity. When we talk about a neighborhood or a community, it is the foundation of creating a natural ebb and flow of supply and demand to function in partnerships. When all the suppliers and the buyers are not utilizing or included in making that local system operate, the muscles start to shrink. The neighborhood's power gets discounted and then left out of considerations when decision makers put their new equations together. A CDFI's purpose is capital focused, but must be accountable to the market that it serves. CDFIs leverage existing assets in a neighborhood and keep them there. So what are the specific products and services used by CDFIs to build and support assets? Let's take a look at some on the next slide. They go the gamut, and 2 members of the NeighborWorks network will follow my presentation to share with you the specific programs, products, and services they deliver in their target markets. But in general, CDFIs can provide a smorgasbord of answers and options to meet the needs in your communities. Residential mortgage lending is hot with the affordability issue that we have in this country. Commercial real estate, serving micro small businesses, serving the largest businesses and getting them to come into the communities and provide those and create those jobs. Being an intermediary, not just lending funds to a individual or a business, but also lending to other nonprofits. We have a number of intermediary CDFIs on the call today. Consumer lending, it's really taken on a different light over the last 5 years or so. And then, of course, our big focus around climate and the resiliency issues that we're looking to help roll out in our country today. Next slide. So one of the items often asked of nonprofit, unregulated CDFIs is, do we need to be licensed to offer a particular product or to deliver a service? The answer is maybe. It depends on where you're located, where the product is being delivered, who's borrowing it, what type of product it is, and the compliance requirements identified by the investor. I'm not the licensing expert, but I do know that one of the CDFIs presenting after me can share the fun experiences of acquiring and maintaining a license to lend in New York State. Next slide, please. If you're considering offering loan products, the NMLS system is a must-see. Just make sure you've had your dose of coffee before starting. Next slide, please. Development services are provided or sponsored by CDFIs and required to support the financial products you deliver and create an informed borrower, whether it's an individual, a business, another organization, or entity, and could include things like home buyer ed, informing contracting before someone partakes under rehab or renovation, one-on-one counseling or TA, helping a small business develop a plan of action, coaching and connecting peers amongst growing businesses, something as simple potentially as a referral. Somebody wants to start a business and this one you financed in the past can be of assistance in guiding that person. Another one that has taken on some steam across the country was making sure that small businesses have access to procuring with government entities. These services really protect and prepare the borrower that CDFI serve. CDFIs have proven time and time again that the capital invested in their borrowers have a lower delinquency and a default rate than mainstream capital markets. Why? Well, one that weighs heavily is this risk mitigation or handholding that is the culture of CDFIs that we deliver by these services that you see up on the screen. You don't see the word trust listed as a product or a service, but the relationships that CDFIs build with their borrowers and their partners distinguish them from any other financial institution. Next slide, please. As a certified CDFI, you must identify where and who are the recipients of your products and services, and those must align if you are going to become a certified CDFI with those that have been identified as eligible by the CDFI fund. Pretty typical census tracts, the income levels, and specific populations. And if your population that you wish to serve is not listed, and you have identified them as being underserved and and not having access to capital, then you can provide that as another potential area to service as your target market. Next slide, please. So in the chat, if you could share with us one or two non-financial partners you rely on to create positive impacts in your neighborhoods and communities. So as these are coming back, look at the names and get an idea of potential sectors that you may not have considered tapping into. Next time you're getting ready to undertake a program or have identified a particular population that needs to be a recipient of lending products or services, you know, get a thought for who you might be able to reach out to by looking at those things that are suggested in the chat. Okay, next slide. So, although CDFIs have been around since the 80s, many new to community development have never heard about CDFIs or seen the industry in action. We're sharing the stories of those who've worked with us to accomplish dreams, and more recently, those who were so severely affected by the pandemic. You are building bridges to find common ground, closing financing gaps, and being trusted because you live where you work. You're moving the capital from mainstream to create an upstream of availability and access resources needed to grow both individuals and local businesses. You know, thinking from an investor perspective, you use your balance sheet and your revenue generating activities to imagine and plan for the future. As much as I would love to say we can compete with existing markets and financial systems, for now, we must use those systems to serve our communities and jointly make commitments to bring assets and keep them revolving in our local ecosystems. Next slide. Here's a quick identification of some of the roles that CDFIs can play, particularly if you're into the mortgage brokering industry, where you are taking on products and capital from another source, or from a correspondent perspective, where you are revolving lines of credit with an investor, and then also from a direct perspective, where you're actually using the equity that you have on your balance sheet to make loans and revolve it and to get it back out again. Next slide. Okay, so I know I am over time, and what I'm going to say from this perspective is that if you have not already shared with us some partnerships that are non-financial, including those in there that you use to help fund your lending operations. So again, looking at the sectors that might be available to you that you haven't necessarily looked at in the past. The next slide. So here's a resource that was just released last week by the Opportunity Finance Network. It gives you a deep dive into where the CDFI industry began, how it has changed over the years, the keys to successfully growing a CDFI, and the challenges being addressed for today and tomorrow. And the OFN website is www.ofn.org. And last but not least, thank you again for sharing part of your day with me.
Thank you, Paula. Thank you a lot for going over that history. You know, I was sort of racking my brain. I certainly lived through it, but I think there were a couple of acts passed to establish and then fund CDFIs, and I'm really glad that you shared that last resource. There is a lot of history and background, and clearly they were created to meet an unmet need. And it is kind of surprising how many decades it's been possible to have CDFIs, and yet, as you pointed out, how far we have yet to go in terms of there being those kinds of services accessible to all the communities that need them. So I do encourage people to go check that out. And I'm not sure if we ever said it, but in the federal government, it's the Treasury Department that is responsible for CDFIs and funding them and doing some amount of, making sure that they meet the criteria to have that designation. Okay, so let's go on it now and see what it's like for a local CDFI, what kinds of work they do, and how they partner with neighborhoods to help achieve their goals. We're going to have Gwen O'Shea, again, who is the CEO of CDC of Long Island, talk to us about what her organization does. And I think we've alluded to and have established that being any kind, whatever, even though a certain amount of what you do is regulated by the federal government, every state has its own set of regulations that they apply to lending practices. And in New York State, where Gwen is operating, it's quite a lot of regulatory environment for her to deal with. So take it away, Gwen.
Thank you. I just want to double check. Can I forward slides, or do I just ask for the slides to be forwarded? I wasn't sure what the.
Either way, Gwen, however you want to do that. I can advance for you, or I can give you control and you can.
Oh, if you want to give me
launch on your end.
control, that would be great. If it's easy enough to do. You know, don't worry about it. Don't worry about it. We'll just leave it as is. Thanks. So, good afternoon, everyone. I am Gwen O'Shea. I run an organization called Community Development Corporation of Long Island, otherwise known as CDCLI. As you can imagine, during the pandemic, we really tried to illustrate the LI part because many were confused with us as the other CDC and calling for lots of information that we couldn't necessarily provide. So happy to, like I said, underscore the LI. As it was noted, we, next slide, please. We serve Long Island. A little bit of information about us. We were established in the late 1960s, really with a focus on creating affordable housing and providing the community development necessary to do so throughout our region. We have been serving not only Nassau and Suffolk counties, but most recently Queens and Brooklyn counties as well. As noted in the introduction, we are an exemplary rated member of the NeighborWorks network and very much appreciate our opportunity to partner with them and leverage some of the resources that they provide, which I'll talk a little bit further about as we go through the presentation. Next slide. Oftentimes when I say to individuals that I work within a community development and affordable housing organization space, individuals ask, what does that mean? And so here I apologize for the very small font, but it helps to illustrate the complexity of the work that we do and the depth of the work that the team does here. We cover a number of different business lines, starting with the homeownership center. We also do a lot in the resident services space, which also builds off some of the community building and engagement work that we do. We manage a very large rental housing assistance program, otherwise known as the Housing Choice Voucher. We administer close to 10,000 vouchers across Nassau, Suffolk, and Brooklyn counties. We do quite a bit in the home improvement and optimization space, as well as housing development and planning, under which our portfolio of rental units sits. We have about 1,500 units of affordable housing in partnership with for-profit developers. We also have over 50 units of combined rent-to-own properties, as well as rental properties that we manage. And then we have our lending arm, which now is primarily consisting of residential lending, but I'll talk a little bit more about some of the other services we have provided under our CDFI. But I wanted to illustrate the different lines of business because there is such great cross collaboration to really ensure that we can holistically support individuals and communities as they attempt to do what was brought up at the beginning of the conversation, really ensure the viability, sustainability, and potentially growth of an area that may be challenged. Next slide, please. So again, just to sort of help illustrate our structure here and how we function, we are a chartered member of NeighborWorks America. We have CDCLI serving as our parent corporation. Under parent, we have two affiliates. One, and I apologize, it's incorrect on the slide. This is our CDCLI Housing Development Fund Corporation, under which the properties that I mentioned on the earlier slide that we manage and are responsible for sit underneath that corporation. And then underneath our CDCLI Funding Corporation sits our certified CDFI that is certified both at the federal and the state level. Our CDFI was established in the late 90s, shortly after there was the expansion in the CDFI space, and has been working really to build its presence within our community since that point in time. Thank you. Next slide. So a little bit about our market to help understand how and why we do what we do. For those of you not familiar with our communities, Long Island is one of the oldest suburbs in the country. It also is one of the most segregated suburbs in the country. We are in the top 5 as it pertains to segregated communities, and we are in the top 10 as it pertains to most expensive places to live. So a region that represents a little over 3 million individuals. Our most recent median house cost in Nassau County was $679,000, and the median house cost in Suffolk County was $530,000. As it pertains to our market, single family rental versus ownership, our community is primarily ownership with a very small rental market. We have just about 20% of our product is rental. Close to 80% of all products are single family. And this pales in comparison to our surrounding communities, north and south of us. Counties primarily have, even when looking at more within the suburban context, anywhere from 30 to 40% of their stock is rental. And so that has, in particular in the post-COVID world, really even increased the rental market, much more so for individuals. Right now, to rent a property, the available properties across the island, one needs to make $135,000 a year to cover that rent, which is very much, above the area median income than many of the individuals that we serve, further illustrating the need for the products that we provide. Next slide, please. So quickly, what we do offer through our funding corporation, our community development financial institution currently, as you'll see here, really speaks primarily to residential products. And this is to fill the gap, as I was mentioning, sort of the challenges within our segregated communities and the history of redlining here. On Long Island, similar to across the country, there was an unbelievable level of redlining that took place. Most of our planned communities were funded through federally backed mortgages that had covenants in the deed that only allowed homes to be sold to white individuals. And while those deeds no longer are obviously in place, there still is the implications of what lack of access to capital and home ownership how it has perpetuated the disproportionate disparities in home ownership amongst communities of color versus white communities. And so over the past few years, with this sort of convergence of so many factors, we have really focused on shifting our capital into under-resourced, under-financed, primarily majority communities of color to help break down some of the disparities that have historically been in place. So over 80%, closer to 85% of our lending is done with for and with individuals of color, primarily with individuals in households that are at or below 80% of the area median income. And so we offer a cross-section of products right now, from down payment assistance. We are very pleased and proud to offer one of the only programs in the country that provides lending support for housing choice voucher participants who are looking to use their voucher to become a homeowner. That's a group of individuals that have historically been left out of the home ownership category. So very happy to be supportive there. Our region as Long Island, we are an island. We have, because we are one of the oldest suburbs in the country, our housing stock is extremely old as well. We have just in Suffolk County alone, close to 400,000 single family households whose septic systems are leaking nitrogen into the groundwater. It's a huge environmental concern for us from a sustainability perspective. And so there's new legislation that requires any failing septic system to put in a new replacement system that is much higher quality. And with that comes a higher cost. And we want to make sure that all homeowners have the ability to put those systems and adhere to the new regulations in place. So that's a relatively new product that we've created. Again, speaking to the aging housing stock that we have, down payment assistance and rehabilitation cost is also really critical. Again, looking at the average house cost, for those that are at the lower end of the spectrum, which is really within the price point that many of our customers can buy a home, the house is in dire need of repair to ensure it meets all health and safety requirements for a family to successfully reside there. And so matching a number of products is really important, looking again at the cost within our market. Also home improvement, again, with the aging housing stock here, and looking at the transition in lifestyle needs for many of our residents. We do have a high portion of our residents that are in the aging category, need retrofits to their properties, accessibility modifications to their properties so that they may age in place. We have products there to meet those needs. And most recently, we will be offering a product that helps to build the housing stock very much within these low to middle income communities where property taxes have risen exponentially. The cost of that is really almost unsurmountable for homeowners. We are working with the state to create funds for homeowners to create an accessory dwelling unit on their property, as long as it obviously meets the code of that municipality, will allow for not only homeowners to see a greater increase in revenue in their household, but create another housing opportunity within the much needed affordable housing space here on the island. Unfortunately, the slide is cut off here. It has small business lending, and there also is multifamily lending. Looking at what and how we have served our communities over the existence of our CDFI, we actually started out doing quite a bit of small business lending. Leadership at a point in time decided to sunset that, but we are reevaluating, recognizing the needs of many of our individuals within our communities, the changing diverse needs of our community members, changing in small business borrowing, lending practices. We want to really help support individuals be financially sustainable, not just in home ownership, but also from the business side. And I saw there was a question in the chat about using funds for emergency, potentially disaster related issues. We also previously had a fund after Superstorm Sandy. The South Shore of Long Island was devastated by that storm in 2012, and we were able to work with one of our financial institutions to lend to sort of have a bridge loan for families that were impacted, again, primarily those that were not in higher income areas, had damages to the home. There were delays in the funds coming out from the state and the federal government. And so we created that product so that individuals could complete the construction, move back into their home, and not have to struggle with dealing with another cost in terms of borrowing high interest funds to complete that construction need. And then finally, we also do some lending in the multifamily space, pre-construction funds, recognizing again, the riskiest part of development is in that pre-development funding pool. And so happy to work with some of our development partners here that are looking to create greater housing opportunities on Long Island. Next slide. So that was a mouthful. I apologize. I was trying to squeeze it all into the time frame I was given. Happy to talk further with you all about that, but I want to thank you for listening and appreciate the opportunity to share the great work that the team here at CDCLI undertakes every day.
Thank you so much, Gwen. You know, that is quite an array of lending services. I was really surprised and pleased at things like the septic system replacement lending that you do, the ADU investment. I think it really exemplifies that one of the valuable things about a CDFI is that it can design programs that to meet needs. You know, it is not like, it's actually pretty, I think because they're small and they're local, they're pretty flexible and able to respond to situations quickly without, it being, I mean, it just points out the difference between this and, say, a national bank. Besides just its mission, its ability to act quickly and really respond to very specific needs. I was wondering, Gwen, if you could give us an idea of a couple of things, products that you do that and how they're different from what people might otherwise be able to access in the mainstream lending market. Like, for instance, do you have appraisal gaps when people do rehab, and do your loan products deal with that? Or, are your underwriting criteria more flexible than, a classic home purchase loan product at a big bank?
So thank you for those questions. I would say yes, yes, yes. And that's really the point, right? That's why we're here. So we're here to fill that gap, to fill in the space where financial institutions can't or won't take that risk, right? Or we never want, to your point about creating products and what that looks like to respond to the unique needs of your community. We don't want to duplicate something that's already out there, right? So there are some really great down payment assistance programs, great mortgages. We see the success of our CDFI as being able to leverage, right? There's no one of us is going to carry, recognizing all the complexities that I, was articulating about our market that I know is the same in many of my colleagues' markets across the country. So, for example, when you look at the housing choice voucher lending product that I mentioned, our financial institutions, they just won't take that large of a mortgage risk with that large of a government subsidy. So we actually flip-flop it, right? Normally, when we go into down payment assistance and lending, the traditional financial lender has the larger mortgage and is taking the greater risk there because the risk is actually less. When it comes to a voucher homeowner, again, with that subsidy being dependent on a variety of other criteria, we take the greater risk there, but we're also able to offer a product, a 30-year at 1% that's paid out at the tail end. That math doesn't work for financial institutions. Back to Paula's opening comments, we're mission driven in what we do. I mean, we're not going to lose our shirt in terms of lending, and we're not going to risk capital that is going to put an individual or a business in jeopardy of further financial hardship. But we do have the ability to have a different read when you talk about the bottom line.
Yeah, your bottom line is in a different place. And the other question I have for you, Gwen, is can you give an example of perhaps when because I know you cover a lot of territory, a neighborhood that you hadn't currently been focused on, or a city within your larger geography approached you and said, hey, we don't have any special lending services in our community, but we have this need, and could we work with you to design something?
So it's a great question. We actually are in the midst right now of conversation with one of our municipalities where they have, and I see that in the chat here, there was a question that came up about economic development corporations, within a municipality. I think that that's a great place for leverage, right? Looking at, they may have access to some capital. They may not have the full comprehensive portfolio of services that I was articulating, in my earlier comments that make it a better use of capital when you're walking through the door of an entity that can really holistically look at what an individual needs and evaluating their ability to be successful with the capital that's being lent. And so they want to take some of the capital that they have and work with us on leveraging more and providing a product very specific for individuals within their communities that they know are in need of capital support.
Great. That's great. I've heard that, some stories about situations where perhaps there is a nonprofit working in a neighborhood that doesn't have lending capacity, but they have great partnerships and access to capital from some sources. They just don't have the capacity, the lending capacity to put it out on the street. And that's another way where a nonprofit might become involved with the CDFIs, like helping to raise the capital that could be deployed in their neighborhood, but relying on the CDFI to actually complete those loans, underwrite those loans and manage them. So I hope one of the things that people are getting from listening to Gwen is that it's perfectly reasonable for a nonprofit, a community group, city government to approach a CDFI and, hey, say, we have a need for capital in our neighborhood that's not being met by the conventional lending market. We'd like for you to brainstorm with us how to meet this need and see if you might partner with us on responding to it. So let's take a little bit different angle and move over to talk to Lynn Meyer from Oregon. And I asked Lynn to join us because his CDFI really focuses more on lending around small business and personal loans than on residential lending, which is a whole other interesting thing that I know less about myself. But certainly many of our middle neighborhood business districts need flexible capital for small business owners or small business potential entrepreneurs. And I know that's one of the areas that Lynn's done some work in. So let's hear all about what he does. Hi, Lynn.
Hi, thanks for the introduction. And hello, everybody. I want to say good morning because I'm on the West Coast, but I hope your day is doing well. So we can kind of move to the next slide and I'll do a quick introduction who we are. So we are Community Lending Works. And again, I'm Lynn Meyer. I'm the Director of Lending. little bit of background. We launched our loan fund in late 2011. We've done over $25 million loans and it's several thousand transactions. We serve primarily 7 counties throughout Western Oregon, but we have been able to lend throughout the state, specifically during the COVID pandemic crisis. And if you look geographically on a map, Oregon is actually pretty large geographically, but the majority of our population lives on the western half of the state. From our loan products, we really have 2 primary platforms. This slide here in a second, we'll talk about some pilot programs that we're doing, but we have our small business loans, which are really our core of what we do is really as a micro lender. We have been able to expand our loan offerings, which I'll talk about here in a little bit, around how the access to capital gap has expanded. So really, we look at loans anywhere from $1,000 to $100,000 as a normal menu item. And we've been able to expand from a pilot program of small business loans up to $250,000. The other unique platform that we have is consumer lending. And we offer your traditional auto loans, personal loans, credit builder loans, really from the smallest loan of $300 up to $30,000. It's to provide that safe and affordable access to capital to both individuals and businesses that traditionally can't find it. So next slide, that's a quick overview of who we are. Again, we'll be able to run through this slide pretty quickly, but our 3 big platforms are consumer lending. And if we hit the slide again, it should come up and say small business lending. And we hit one more time and you'll see this one is separated, and this is affordable housing. We have been able to dabble in affordable housing, and I say dabble because as a relatively smaller to medium-sized CDFI, we only have so much capital that we can put towards affordable housing. But over the last 3 or 4 years, we've been able to play a pretty key role with nonprofit developers of providing pre-development loans and land acquisition loans. Especially as housing crises have happened, it's been a really good product for us. That's why it's separated from that pie graph. Hopefully, as we grow, it will be a normal loan product that we move forward. So we can go to the next slide. So this is where I really wanted to spend a little bit of time talking about small business lending. It might be a little different conversation than you've had before, because I really feel, at least in our area, small business lending has seen a change in optics, specifically how we lent pre-pandemic to how we're lending now and how we're going to lend in the future. And I can say very specifically and confidently, at least for us, how we've lent in the past and in the now is going to look different in the future. What I mean by that is there's a couple different unique problems that our borrowers are facing right now. One, we're still dealing with pandemic-related concerns from a small business, whether it be labor shortage, supply chain issues, inflation, etc. We're also seeing the access to capital gap is broadening in our area. We are seeing community banks and our traditional lending institutions really taking a step back from that smaller capital/credit ask. And that number varies depending on the institution. It's not uncommon, and I hear this directly from administrative staff, from lending staff and underwriters and clients ourselves, that they are not entertaining credit asks really under $250,000, sometimes $300,000. So we've been able to try to figure out how can we step into that role. That also brings me to my next point is, as a CDFI, capitalization is really critical. Most of us are familiar with the term patient capital from a funder, where it's very flexible for us. There's long terms, there's very favorable interest rates, so we can re-lend it at a favorable rate to the borrowers. But more importantly, it's how do we meet the financial metrics and the mission metrics from our funders, because sometimes those have challenging times of alignment. So as we look at businesses coming online, we may have to look at loans that have a period of non-payment, a longer period of interest-only payments to really get them online and coming forward. So having an agreed understanding of what the patient capital means as we seek capital is really critical. Creating loan products that help address the capital concerns. What we've been able to do, and this will kind of fast forward to some slides coming up, is really look at what are some of the challenges that our communities, our borrowers are facing. And one of the most traditional ones that we see is understanding that collateral and personal assets can sometimes be a barrier to accessing capital. So as we're going to talk here in a little bit, is really pushing your organization, your board, your funders to understand that we need to understand what are some of the challenges that are going on. We can't solve all of the problems, but how can we as mission-driven lenders work to be able to be a solution in some of the capital concerns? And again, that's also in understanding and embracing that the capital gap is increasing. A lot of us are concerned as smaller CDFIs. We've traditionally, I have this conversation frequently with peers, we've traditionally done smaller loans. How are we going to expand our loans from a capitalization point of view? I would encourage all of us to think about how do we understand and how do we embrace that access to capital gap? From really a CDFI perspective, it's an amazing time to be a CDFI. There's opportunity that is probably going to be with us for the next 2 to 3 years that traditional financial institutions aren't going to seize. But yet, if we can do the right thing, build up our businesses, give an opportunity for access to capital, our borrowers are going to be able to be strong referrals back to those financial institutions for traditional loans. Real quickly, embracing technology and remote lending relationships. As a large geographic state, we can't have boots on the ground everywhere. So we really focus extremely hard of building strong relationships with both financial institutions, municipalities, you name it. About 1/3 to 2/3 of our business, depending on the month and the time of the year, really come from financial institutions from a referral point of view. Because our theory is we want to be there to make their clients stronger for them. So they know that we are non-competitive, we're filling a gap, and we're just a strong community partner. And the last thing is really forecasting and understanding the challenges that we face as mission-driven lenders. And that kind of ties back into there are times where you have to have difficult conversations with funders, with legislation about opportunities that have been there to include mission-driven lenders in some of the unique products that are available in the state. We've spent a lot of time testifying in front of legislation that there's been risk mitigation tools in the form of loan loss reserves and loan guarantees available to banks and credit unions, but mission-driven lenders, specifically CDFIs, have been left out of that. So we've spent a lot of time really understanding what are the opportunities, what are the challenges in uniting and trying to fight for those tools. So for the next slide. So this is kind of going to that fast forward comment that I made, is that we've been able to create some unique loan options. Number one, we tried to create lesser collateral options. We also pushed our board in a unique and a difficult way early in the pandemic, is creating loan loss reserves and creating set-aside account, and not a loan loss reserves in the normal sense, which we have a fairly robust loan loss reserves, but taking part of that, setting aside to where we can do lesser collateralized loans, taking a reserve towards that, and really from a proof of concept side. Our theory has always been collateral does not dictate success of a loan. It makes lenders sleep well at night. Most of you will probably laugh at that comment that, you know, collateral is one of those things that really makes us sleep well at night. We know if something goes wrong, we're going to be able to get our investment back. However, that methodology sometimes creates that barrier for access to capital. So what we did is we created our version of a small loan guarantee that we can take a reserve with it. And we took part of our traditional loan loss reserves and created a set-aside account. And we started proving the concept, and we've been able now to bring a couple foundation investments into that account to grow that so that we have more lending capacity. It's also helped secure a significant loan loss reserve investment through the state of Oregon that will be coming online very soon, but we were one of the early awardees of it. So we're really excited that we challenged ourselves in an uncomfortable way to take some of our funds and set them aside and utilize them to support these lesser collateralized loans. I love the term pilot program. Really, all that means to us is it's living and breathing. As we know more, we're able to adapt and change policies. We have an active loan committee, an active real estate committee. So we're able to really fine tune those versus put them set in stone, and we'll review them on an annual basis because sometimes folks get left out. So as a very high level, we created 2 lesser collateral options for existing businesses. We will lend potentially down to 50% collateral coverage. And again, those of you that do small business lending understand that there's many different factors to get to that 50%, but as a baseline, we will lend down to 50% collateral coverage. On a startup business, we will look at those, and we potentially will look at a loan of 60% collateral coverage, which is a really big tool, because as that access to capital gap broadens, so do credit criteriums when we look at traditional lending. So that requirement of your traditional one-to-one collateral, or as close as you can get to one-to-one collateral, is sometimes a barrier for folks, especially when you're lending in urban, rural communities, when you're dealing with populations that traditionally do not come from historical wealth. Specifically, when we're working with BIPOC communities, they do not have historical assets, and it's been a barrier. So how do we leverage our loan funds, our loan loss reserve, to create loan products that start to bridge that gap? It doesn't solve all of the problem, but it starts to provide solutions. So next slide, please. So this is this is kind of a pivot conversation, and this goes along with raising capital, creating patient loans, investor relationships, etc. Is that really understanding the CDFI ecosystem? And Paula referred to OFN CDFI 101 document that was just released, and I applaud them for doing that. And thank you, Paula, for bringing that up. Because this is my personal opinion, what I have found is over the last 20 years of engaging both with my current organization and previous organization about CDFIs, we are probably one of the most misunderstood financial tools that are out there. So what I would encourage you is to spend a lot of time with your local banks, your local communities, utilizing the CDFI 101, and work on folks getting a baseline understanding of what CDFIs do and how we can help in the community. Those of you that are CDFI lenders already that have been out raising capital, it's kind of shocking sometimes when you talk to commercial banks, even CRA potential investors and foundations. They have limited knowledge or experience working with CDFIs. And really, how can we help and increase exposure and strengthen existing relationships? Is spending time as much as we can telling the CDFI story, prepare success stories. What we have learned, especially from a legislation point of view, is they love the financial metrics. How many loans have you deployed? What counties do you work in, etc. But more importantly, they really want to hear the success stories. And that's one thing that we as an industry do an amazing job. But how do we tie that into the work that we do versus moving communities forward? So want to make sure that I am keeping within our time limit. So that's the end of my presentation, and I'll take any questions that are available.
Thank you so much, Lynn. I have a question for you and for Gwen, which is, I think something we sort of skated past, which is, what are all the sources of capital that you use to make loans with? You want to start with that, Lynn?
Yeah, wow, it's very diverse. So I'll give kind of the high level. We've got grant funds from the CDFI fund, we've got foundation funds, private investors, USDA funds. We have municipality investments, retained earnings. We probably have anywhere between 6 and 12 different capital sources at any given time. So it really ebbs and flows. The one area that we have not ventured into yet is looking at SBA financing and capital. We've been approached multiple times, but we'll probably look at that in the upcoming year.
And so when municipalities partner with you, are they using are they big enough to have like CDBG funds that they hand over to you?
Generally, it's a CDBG investment. And some of these have come through whether it be ARPA funds or some of the early COVID
Oh.
money that has been returned, and then they create a revolving loan fund with that. But traditionally, it is your CDBG money.
And then you also have foundations. Do you ever
We
have,
have about 6 or 7 foundations that we've received multiple grants, but specifically several leveraged PRIs, which is program related investments. It's a tool that allows foundations to invest into funders like us.
so when they do that, they basically say, we're going to put X hundreds of thousands of dollars or millions, if you're lucky, in with you for a very low return or no return for a certain number of years, and you can lend it out and do what we've agreed with you to do. Is that how
That's
it works?
exactly right. That's exactly right. You know, what you're looking for is, what is the mission connection? First off, you know, what is the mission connection? What are we trying to achieve? And then trying to make sure that it is capital that's usable based on the time and the circumstances, as far as length of capital and the cost of capital. Those of us that have worked in the capitalization side, we know that the two hardest things, especially in today's times, is to get long-term capital at an affordable rate so we can re-lend it. We can say specifically, when we're looking at small business lending, we want to make sure that we have long enough capital that we can help with those early modifications of payments, not modification in a negative way, but if we need to do a couple of months, no payments to get them launched and interest only, that we have that time and flexibility to do that.
Oh, that's really interesting. Yeah. And how about you, Gwen?
I would say the same. You know, there's a really diverse group of funders and funds that are in our portfolio. I mean, we're very fortunate as a member of NeighborWorks Capital. I mean, that is something that really is a game changer for us, is that we're able to use those funds, those capital funds, you know, for this very purpose that is mission aligned, obviously, and in the development space, you know, that we're in. The CDFI Treasury funds, you know, I know we were talking a little bit about that. Obviously, the fund that was created in the late 90s with bipartisan support to continue to move out, you know, such critical capital across the country is really great, because if you can meet the leverage requirements, it's free cash, you know, for the purposes of staying, you know, in your lane from a lending perspective. Those are some of the greater, I would say, funders within our space. And then New York State, through their Empire State Development funds, have also made a good amount of capital available to CDFIs across the state.
Oh, that's really interesting. Okay. You know, one of my I think I've actually seen this before, and I could imagine it happening with some of the practitioners I know in the middle neighborhoods, community practices, that they may have a relationship with a foundation that's very strong around other work and be in a really great position to bring that foundation to a partnership with the CDFI and talk about how they might make a program related investment or some other kind of capital investment in the CDFI that would allow it to do some lending that would further the work of that nonprofit. So I think there's all kinds of ways that people can partner. Sometimes they can bring capital to the partnership, and sometimes they can just bring a need and try to solve it. I see there's a couple of questions in the Q&A from Megan Irwin. Megan, if you're still with us, do you want to unmute and actually talk a little bit more about where you're from? There she is. Oh, good. Go ahead and unmute, Megan. Or do we have to unmute you? Nope, there you go.
Yep. Actually, only have a couple minutes. I have to run at 1:15.
Okay.
But yeah, so I'm from Norfolk, Virginia, in the Hampton Roads area here. You know, we're over 1 million kind of metro area in terms of population, but really only have a couple of CDFIs, one that does primarily commercial work, and LISC, which just came to Norfolk, but also hasn't really built their portfolio yet. So we're looking into the CDFI friendly concept, which started in Indiana, I believe, to leverage non-local CDFIs, and just was curious if anybody had any experience with that.
I'm not familiar with that description myself. Are you, Lynn or Gwen?
No, I have not heard it. I was going to make some assumptions, which I know we should never do, right? But about, being willing to lend in other areas. Megan, I don't know if you have further context of that or definition of that term.
Yeah, it's typically a nonprofit organization that's may or may not be a CDFI themselves, but they operate as kind of a liaison between folks who need capital and folks who have capital in order to leverage capital options from all over the US in case folks specialize. For example, he was the person I was speaking to in Bloomington, Indiana, where this concept kind of started. Was they leveraged a CDFI, I believe out of New Jersey, who specialized in co-ops. But it's an option, I guess, for people who don't have, typically more rural areas, right, who don't have CDFIs, but for some reason our area fits in that category, even though we're a big metro area.
I mean,
So-
as long as their, state regs allow them and they have, certified as an entity that would cover a broader, footprint, that sounds like a great idea. I know we have a CDFI here on the island that does a lot of work within differently abled situations, both from a residential, commercial, business space, and they lend nationally. So it's certainly, feasible. It's a matter of connecting with the right partners.
It does make sense to me that I think that CDFIs can choose what their territory is, right? You can either be a statewide or you could be local, or how far can you take that? Can you have a national charter?
You can. I mean, there are certainly national CDFIs. I don't
Okay.
want to even attempt to start speaking around regulatory aspects there because we are not. So
Yeah, right. I get it. But I think it just in general, Megan, I love the idea that you're bringing up that even if you don't currently have a local CDFI that's set up or has the mission or the capacity or whatever to do the kind of lending that you need, you shouldn't stop locally. Start to look statewide at what other CDFIs might exist. And who, Lynn and Gwen, what kind of state government department would somebody contact to understand what CDFIs were operating in their state?
Department of Financial Services or an entity is, I mean, again, I'm not sure on every.
It's in New York,
structure,
okay.
but for the majority of states, that's usually the go-to. Lynn, is that the case for you?
Yeah, you would want to start with your state agency from a regulatory point of view, but the other thing you can look at is at cdfi.gov, they will actually have the ability to search CDFIs that are active in your state. And then CDFI Coalition as well will have a fairly in-depth list. So really between those three, if I were to start somewhere, I'd go straight to the CDFI website because that's going to give you the active certified CDFIs in your area.
Yeah, I think that's really great advice. And Megan also asked, she's probably had to take off by now, but I think she raises a question that's not uncommon. Financing for home repairs and how difficult that can be to access. And so it's something I know that you do, Gwen, right?
We do, and we have two different products actually. So there is the leveraging opportunity there. Our state housing agency through the Affordable Housing Corporation makes resources available so that it's a forgivable grant that can then also be matched with additional low interest capital, recognizing the challenges of state caps on financial support that may not necessarily meet the need of the home buyer and or the property. So we want to make sure again that we're getting someone into a healthy and safe situation without over leveraging them or over compromising their financial stability. I would imagine, again, it's a good place to look in terms of state housing agencies and what sort of products are available through there. There might be other partners that have, you know, that relationship with those agencies, and providing those supports could be a great mix and balance between loan products and forgivable loans and grants to really get those repairs over the finish line.
I like how you put that over the finish line, because it often takes a variety of different things, depending on, you know, it's an unfortunate thing that, of course, the housing stock that needs the most repairs is always occupied by the people with the least means to do it, right? So I don't know why. I personally always wonder what a nation thinks is going to happen to its housing stock if there's no concerted effort to make sure that it's maintained and repaired as an asset for future generations. But it's certainly, there doesn't seem to be any national coherent strategy around that, as far as I can see. It's something that I've certainly focused on throughout my career. Is one of the strategies for neighborhood revitalization is attending to that housing stock. So I think it's always a patchwork quilt, unfortunately, for us, of finding the right capital, and that's loan capital and grant capital, and dealing, you know, with what we have in terms of after rehab appraised value and what that means about lending capacity. But, you know, there is really, there are many practitioners out there who know a lot about this topic. So if anybody really wants to know more about it, feel free on this or anything to reach out to me. And I love to make connections for practitioners with other practitioners around the country that are doing a lot of what they need to know more about. Any other questions? Here's a question for Lynn from Raquel. Affordable housing lending, do you lend for new construction as well as AC rehab?
We don't. Right now, we're just doing the land acquisition and pre-development. You know, we're starting to look at different options. Our affiliate company, which is now called Dev Northwest, works more in the affordable housing sector. I would like to add a comment that was just brought up about, you know, the lack of affordable financing for rehab and housing products. One of the unique things that has happened in our area, other than the pandemic concerns, was wildfires in the last couple of years. We've seen a significant growth in wildfires, specifically in Oregon and California. In Oregon, just like a lot of states, the cost of housing has been a huge concern. One of the unique sources of affordable housing that was aging almost beyond repair was manufactured housing. So we had pre-pandemic conversations with different funders of how can we potentially, as a CDFI, offer loans to rehab these manufactured homes, because they are, from an affordability point of view, safe and viable housing, but they're aging to the point where they need significant repairs. And the biggest challenge that we ran into is, how do you find long-term affordable capital that makes those repairs justifiable and cost-effective? Fast forward a couple of years, the state has lost, and I don't want to pretend to know all of the numbers, but a couple thousand units that were in that were burned. So now we are faced with not only trying to solve the original concern, but how do we replace that type of housing in today's prices, when a lot of times these parks were totally wiped out. We actually, the one area that was a little unique for us is we partnered with the local housing authority to repurchase a burned manufactured property up an area that was just destroyed by wildfires, and they are in the process of redeveloping that with federal funds. So we were not able to access those funds, but we were able to give them the land acquisition and the pre-dev money to do the upfront work, while all of the grants and the fundings for FEMA, et cetera, came in to be able to partner. It's kind of a unique way that we were able to be a partner in that project, but still a very loud voice in the room to say, we still, now we had one problem, now we have two, but the reality is we have to find long-term affordable capital to be able to solve that.
No, it's such a good point. And I see James has some comments about doing more in the first mortgage space. And I think those two pieces are aligned. And as I mentioned, the CDFI, the Magnet Fund, while it's wonderful, I mean, it's a 10-to-1 ratio, I mean, it's not, when I say it's free money, it's not like, it's just like, can I just have $2 million? There's a lot that you have to bring to the table. And clearly for some of the gaps that we're talking about, we need a much larger investment of capital that allows for the long-term affordability. And quite frankly, is grant funding to CDFIs that know how to really make that work right within their communities. And that's certainly something I would call on all of us, to advocate for, that, that there is those resources, looking at funding that is coming out, of the federal government to really get at some of these long-standing historical challenges.
Yeah, James, you bring up some really important points. And I wonder, I know Raquel is on the call. I think she's still here. Raquel, I wonder if you could describe the National Homeownership Initiative that you're part of that is really trying to close the racial homeownership gap.
Hey, Marcia, can you hear me?
Yeah, go ahead.
Yeah, hi. So speaking of the Homeownership Alliance.
Yes.
Reduce the screen. Yeah, from NCST's perspective, forming the Homeownership Alliance was just critical. I think having, first off, your leading nonprofit affordable housing developers across the country who both do development, some of them do lending, have their own CDFIs, and positioning the work around supporting really at a public policy and federal level, those programs, if you will, and maybe some of us know all of them that I'm about to mention, but your federal home loan bank programs, the CDFI programs, obviously, any opportunity that we have to try and create a specific allocation for the single family asset. We all know that multifamily gets a lot of funding in this country, and being able to get specific, allocations for single family development to help create more generational wealth, right? The more affordable homes that we have in terms of production, the more that families can begin to build that asset and that wealth class. And so we started that about 2 years ago under the Homeownership Alliance. I would ask everybody to check it out at NCST's home website. I'll put that in, Marcia, if you don't already.
Great.
And just learn more about it. I mean, it's a growing advocacy group. Like I said, right now, about 30 founding members of that we launched in 2020 with Chris Siglin, our VP of Policy and Partnerships, leading. So we're really excited about it, and it's gaining so much momentum that it can only, just get larger and greater advocacy for all of us here. They're in this work.
Yeah, it's really important. I'll toss in my own personal philosophical thing, which is that, I feel like each of us in our personal spheres of influence have to start talking about Black prosperity as the goal instead of survival. I think we need to work on Black middle neighborhoods and work on redressing these huge gaps in equity in all areas in a way that's really allowing people to succeed in big ways. I think so for so much of my career, when people have looked at neighborhoods that are mostly people of color, it's all the strategies have been around how can we help people just basically survive. But I really think we need to change that perspective. We've talked a lot about that when in the middle neighborhoods community practice, when we talk about Black middle neighborhoods in particular, that it's time to think about how do we focus success and prosperity as the long-term outcome, and let's move the kind of capital that we need to move to make that happen. So, but it helps when you're part of an alliance like the one that Raquel runs, and there's several others out there, so that you don't feel like you're doing it all by yourself. So thanks everybody. We have to close for now. I think Anne has, please join us at middleneighborhoods.org. At the bottom of any web page, you can join our community of practice. We would love to help you. We have or be partners with you and have you help us deliver content that's useful to all of our members. Upcoming, we have a community engagement chat on April 18th, and the focus is going to be about supporting energy efficiency and environmental sustainability in middle neighborhoods. And by the way, we're looking to develop a webinar about that sometime in the next few months as well. So if any of you have done some practitioner work in that area, please let me know. You can always contact me at Marcia, M-A-R-C-I-A, at middleneighborhoods.org, or Anne, always knows everything. And I think our next slide is about an upcoming topic that's going to be interesting. We don't have a title for this yet, but on April 20th, we're going to have a webinar with a team of researchers from Cleveland State who are funded by Robert Wood Johnson to really dig into who are the middle neighborhoods, what are their characteristics, how does middle neighborhood revitalization affect the lowest income households in those neighborhoods, and what are the key issues facing those neighborhoods. And this is like the most research that's been done about neighborhoods of any stripe, let alone middle neighborhoods, since we started the Middle Neighborhoods Initiative. So we're really excited about hearing about those findings. So stay tuned for that. Our partner, Center for Community Progress, has another great webinar series, the Cornerstone Webinar Series. We always like to promote them. And always email us if you have ideas for webinars that we should be doing to help you out, or in which you can talk about something you think would be relevant to other practitioners, case studies that we write up, share your news stories so we can put them in our newsletter, etc. And I think there will be a survey that comes to you after we close out the webinar. We'd love to hear your ideas there. So thanks, everybody. Did I miss anything else that came up? No. And we're going to let everyone go today. And thanks for joining us, and we hope to see you next month.